Okay, so let's start our discussion. In the previous class, we were discussing investment appraisal area, and we did first topic that was NPV. We did topic of net present value, and we completed 3 questions on that. Then we started adjusted present value. It was a bit advanced topic, but a very good investment appraisal technique. Adjusted present value technique says that while you are doing investment appraisal, what you should do is that you should calculate the net present value of the project based on the project specific risk and the project specific rate of return. You should not use the weighted average cost of capital of the whole company. Rather, you should use the rate of return which is as per the risk of that project. Okay, and through that we calculate the base case NPV. Once we have calculated the base case NPV, then we do certain financing adjustments. Once we have calculated the base case NPV, the next step will be that we will do certain financing adjustments. Now, what are the financing adjustments? The first financing adjustment is of the issue cost. That the company says that if the project would have raised the funds from the market, they would have incurred issue cost. So we also need the issue cost which we are incurring. Okay. Number 2 was the tax benefit on that issue cost. Okay. Yeah. Number 3 was the tax benefit on the interest expense. Tax benefit on the interest expense on loan capacity due to the project. Okay. And the last was the benefit of the subsidized loan. Yep. Okay. And we did one question that was Fubiki company, a very good and a detailed question. We calculated base case NPV and we considered the financing adjustments also. I hope that you remember. Okay. Yeah. Today we are moving towards another question that is Burung company. Okay. This is similar to, this is similar to Fubiki company question.
Burung company, yeah. So this is another APV question.
Yeah, this is another APV question. We will do 2 more questions of APV. One is Burung company and the other one is Ambreli company. Let's start. Just a second. Oh. Let's start it. Burung company. Okay. So you have recently commenced working for Burung company and are reviewing a 4-year project which the company is considering for investment. Okay. Now, the project is in business activity which is very different from Burung company's current line of business. Okay. Now, the following net present value estimate has been made for the project. Okay. So there is a net present value estimate which is already made: sales revenue, direct project cost, interest. Now, we never include interest payments in net present value estimate. Why? Because the discount factor which we use already includes the impact of the cost of capital. So there is no point of including the interest expense separately.
So we don't include that in the relevant cash flows?
Because the impact of the interest is already covered in the cost of capital. When we are discounting through cost of capital, then there is no sense of including the interest expense separately.
So what can I make a note of? Shall I just say that don't include interest in?
Don't include interest and dividend payments because they are already, their impact is already included through cost of capital. Okay. Then there is profit, tax, investment and sale. Cash flows, he has used discount factor of 7%, and then there is a present value. Net present value is negative 1.65 million, and therefore the recommendation is that the project should not be accepted. Notes to the net present value appraisal. Now there are some errors which he has explained in the notes. Let's look at them. In calculating the net present value of the project, the following notes were made. Since the real cost of capital is used to discount cash flows, neither the sale revenue nor the direct project cost has been inflated. It is anticipated that inflation rate applicable to sales revenue is 8% and direct project cost is 4%. Okay, so we will include the impact of the inflation. Okay, he has not considered the impact of inflation
Mm.
because he has used the real cash flows. The project will require initial investment of 38 million. Of this, 16 million relates to plant and machinery, which is expected to be sold for $4 million when the project ceases after taking any taxation and inflation impact into account. Okay.
Yep.
Tax allowable depreciation is available on plant and machinery at 50% in the first year, followed by 25% per year thereafter on reducing balance basis. A balancing adjustment is available in the year plant and machinery is sold. Burung company pays tax at 20% on its annual taxable profits. No tax allowable depreciation is available on remaining investment assets, and they will have nil value at the end of the project. Okay. Now, if you look at it here, he has included sales, he has included direct project cost, he has included interest, profit, and then he simply charged the tax. He failed to consider the impact of capital allowances. Okay.
Yes.
Then Burung company uses either a nominal cost of capital of 11% or real cost of capital of 7% to discount all projects, given that the
We take
rate
off
of inflation has
11%.
been stable at 4% for a number of years.
They've taken 7% as the
Yeah,
discount factor.
because they said that we haven't considered the impact of inflation.
So that's wrong, obviously. We have to do it for 11%.
For APV, we will consider the inflated cash flows. Okay, and then we will use the project specific cost of capital, which is based on the beta asset of the project.
Yeah.
Okay. Interest is based on Burung company's normal borrowing rate of 150 basis point over the 10-year government yield rate. At the beginning of each year, Burung company will need to provide working capital of 20% of the anticipated sales revenue for the year. Any remaining working capital will be released at the end of the project. Working capital and depreciation have not been taken into account in the net present value calculation above. Since depreciation is not a cash flow and all working capital is returned at the end of the project. He has not included the impact of tax allowable depreciation and working capital in his NPV calculation. Okay. Further financial information. It is anticipated that the project will finance entirely by debt, 60% of which will be obtained from a subsidized loan scheme run by the government, which lends money at rate of 100 basis point below the 10-year government debt yield of 2.5%. Our normal borrowing rate is 150 basis point above the government yield.
Yeah.
And the subsidized loan is 100 basis point below the 10-year government yield.
Yeah.
And government rate is 2.5%. So this means that the subsidized loan rate is 2.5 minus 1, 1.5. Whereas normal rate is 2.5 plus 1.5, which is 4. Okay.
How do you know the normal rate is?
10-year government debt yield rate is 2.5%.
Where does it say that?
Please look at the screen.
Oh, okay, sorry. Yeah.
Okay. So the subsidized loan is 100 basis point below 2.5%. So that will be 1.5%. Whereas our normal borrowing rate is 150 basis point over the 10-year government. So that will be 2.5 plus 1.5, which will be 4.
Okay.
Okay.
The normal rate is 4%.
And subsidized rate is 1.5%.
The government will lend us at 1.5%.
Issue cost related to raising the finance are 2% of the gross finance. The remaining 40% fund will be funded from Burung company normal borrowing sources. It can be assumed that the debt capacity available to Burung company is equal to actual amount of debt finance raised for the project. Okay.
Yeah.
Burung company has identified a company, Lintu company, which operates in the same line of business as that of the project. It is considering. Lin2 company is financed by 40 million shares trading at $3.2 each and $34 million debt trading at $94 per $100. Lin2 company equity beta is 1.5. The current yield on government treasury bills is 2%. And it is estimated that the market risk premium is 8%. Lin2 company pays tax at 20%. Both Burung and Lin2 company pay tax in the same year when the profits are earned. Calculate adjusted present value. Okay. Again, I would say the question is not difficult if you remember the steps and you follow the flow of the question.
Yeah.
Okay, so let's look at it. This question will reinforce your concepts which you have learned in a FUB key company. Now, let's start this question. Burung company. The project life is of how many years?
4 years.
Yeah. Adjusted present value.
You're not tired, sir. It's late for you, isn't it?
Yeah, but because we are taking classes from the home, so too much energy is not wasted. Because when I go and teach it physically, that is very big problem because in morning I teach in A-level colleges and they are in different parts of the city. So I travel a lot. So due to that traveling, usually I got tired when I go teach physically. But in this home-based teaching, this online teaching is very much comfortable for me. That we have to sit in one place and I don't have to travel. So for me, Corona is very good.
Me as well, for everyone, I like it as well.
Yeah, for office, those who are working from home, the Corona is very good. That you are relaxed, you have to work from home.
Yeah.
No, but in Pakistan, there is an announcement that schools will and all the educational institutions will get open from 15th of September. So, well, let's see. Now, the project is of 4 years. Yes, he has made us the entire schedule 0, 1, 2, 3, and 4. So let's start now. First of all, again, we will look at the operational cash flows.
So
0,
sales.
1, 2, 3, and 4. First of all, we will pick sales revenue.
Yep.
He has provided us some detail of the sales, but the problem is that he haven't considered the impact of inflation in sales.
Yep.
So that we have to do it ourselves. Workings.
So it's 8% increase in sales.
Workings and sales. Okay, so let's look at it at sales. 23.03.
We have to do the. Don't we have to do the? Do we have to do the power?
Yes. We have to use the concept of the power because the sales number is already increasing, maybe due to increase of units. So now when we have to put the impact of the sales, so we have to use the concept of power because in year 2 we have to inflate it twice.
So the
What
first
I'm
one
doing
is.
I'm just taking the picture of this because otherwise I have to change the screen too much. Now, so let's look at it. Year 1, year 2, year 3, and year 4, 23.03 million.
Times 1.08 to the power 1.
1.08 power 1.
Is 24.87.
24.87.
Yep, if you do the next one, that is...
Okay, so 23.03 million into 1.08, it is 24.87. Then
next one is 36.6 times 1.08 to the power 2.
36.6 million into 1.08 power 2, yes.
That is 42.69.
42.69. Okay, then 49.07 million.
Yep. Times 1.08 to the power 3 is 61.81.
81, and the fourth year sales is 27.14 to the power 1.08 power 4. Yes, what will be the number?
36.92.
36.92 million. Okay, so these are the sales numbers: 24.87, then 42.69, 61.81, 36.92. Okay, so these are our sales amounts.
Now direct project cost.
Then let's move to working 2. That is for direct project cost, because
That
included in the schedule.
Increases by 4%.
Direct project cost. Okay. Direct project cost is 13.8, 21.96, 29.44, and 16.88. Okay. And the growth rate in direct project cost is 4% per year. Okay. So
First one is 14.37.
year 1, year 2, year 3, year 4, 13.82 million. Number 2 is 21.96 million before inflation, I'm writing.
Times,
Third one is 29.44 million.
And 16.28.
16.28 million. What was the inflation rate?
4%.
1.04 power 1, 1.04 power 2, 1.04 power 3, and 1.04 power 4. Okay.
First one, 14.37.
14.37 million.
Next one is 23.75.
23.75. Then
33.12.
33.12 and 16.28 into 1.04 power 4. 19.04. 14.37. So we are putting up direct project cost. Okay, 14.37, 23.75, 33.12, and 19.04. Okay, so I think that it is not a trouble till now. Sales and the direct project cost. Okay, so let's move forward what he's saying. Then he has included interest. So interest is not included in adjusted present value calculation because the impact of interest will already be covered through the cost of capital used for discounting. Okay, so I'll just write a brief note for you so that you will remember it. Impact of interest expense. Impact of interest expense is not included in NPV and APV calculation, in NPV and APV calculation, as it is already covered through cost of capital calculation, through cost of capital used in discounting. Okay?
Yep.
Done?
Yep.
Let's move forward. Okay, so then he arrived at the profit and then he included the tax. So what we will do is we will first include the capital allowance. Now, the tax allowable depreciation is available on plant and machinery, which is of $16 million. Okay, 50% in first year, followed by 25% per year, thereafter on reducing balance. A balancing adjustment is available. Okay, now the scrap value of the plant and machinery is $4 million.
Yeah.
Okay, so let's look at capital allowances.
So we do, this is reducing balance, yeah?
Yes, but the first year he said
15%, 50%. So
50%. Capital allowances. Year 1, year 2, year 3, and year 4. Net book value, $16 million, 50%. What will be the capital allowance?
8 million.
$8 million.
Then we have 8 million remaining.
8 million is remaining. We will take 25%.
$2
million.
Yeah. So we have 6 remaining.
25%.
1.5.
$1.5 million. $4.5 million. Now, in the last year, we have to take the balancing adjustment. 4.5 is the net book value, and I think scrap value was 4 million.
Yeah.
So $0.5 million will be the balancing allowance. Okay.
Yep.
So if you look at it here, $16 million was the value of the plant and machinery. Yes, $16 million was the value of the plant and machinery, which is expected to be sold for $4 million when the project ceases. Okay. So these are the capital allowances: 8 to 1.5 and 0.5.
Yeah.
8 to 1.5 and 0.5.
Yep.
So these are the capital allowances working for taxable profits.
So should I do that for you? Once I'll start from year 1. 87. 2.5.
Sorry?
First one, 2.5.
Year 1 is
2.5.
2.5.
And year 2 is 16.94.
16.94 and 27.19. Okay. So, sorry.
Together we can do this quite quick.
So we can give paper together also.
I wish.
The amount of tax was, the rate of tax was, yes, Burung company pays tax at 20%.
Yeah.
So let's include the impact of the tax. 20.
It doesn't say whether this is year after. This would be year after, wouldn't it?
It is written that it will be paid in same year.
Yeah, same
in
year,
the last line of the question before requirement, it was written.
Okay.
2.2, 3.3, 27.19 into 0.2, 5.4, 17.38 into 0.2 is 3.4. Okay, then we will reverse the capital allowances. A reversal of capital allowance
8.
8 to 1.5 and 0.5. Okay, then what we will do is now we will put up the investments because now we are free because the tax is calculated and now we can include all types of cash flows. So when we talk about investment, it was given the project will require initial investment of $38 million.
Yeah.
The project will require initial investment. Note number 2, the initial investment is 38 and he has also included in his working. The initial investment is 38 and it is expected to be sold for $4 million.
So scrap value is 4 million.
Okay, so investment is 38 and scrap is 4.
Scrap we add, don't we?
Yes, obviously. So scrap value is 4 million. Okay, now we have to deal with working capital. Because for working capital, there was some percentage of sales which we have to use. Working capital, yes. At the beginning of each year, Burung company will need to provide working capital at 20% of anticipated sales. Okay, so, and let's look at it. Working capital, working number 5.
We do it for working capital for the year before, right?
Yes, because it is always required before the year, at the start of the year. Year 0, 1, 2, 3, and 4. So these are our sales, total working capital, and incremental working capital. Okay?
Where does it say about working capital?
Sorry?
Where does it say about working capital?
We just read it in the question, note number 6. At the beginning of each year, Burung company need to provide working capital of 20% of the anticipated sales revenue for the year. Any remaining working capital will be released at the end of the project.
Got it.
Okay. So what we will do is that we will simply pick up the sales revenue, copy, and this sales is pasted here. Okay, what do working capital? We need 20%, 24.87 into 0.2. So 4.974 in year 0. Okay, then 42.69 into 0.2. 8.538. 61.81 into 0.2. 12.362. Now this is the total amount we need. 36.92 into 0.2. 7.384. Okay. So what will be the incremental amount?
8.
Here we need entire 4.974.
Yeah. And then we do 4.974. We have 3.564.
3.564. Then
8.538. 3.824.
3.824.
And then we have negative. We have 7.384 is negative 4.978.
4.978. And the net amount is 7.384. Okay. So 4.9 is the initial working capital investment. Then we need 3.5. Then we need 3.8.
Yep.
Then we will take out 4.9. And then we will take out 7.3. Okay?
Yep.
I hope that you are understanding it.
Of course, of course.
So we are done with sales, we are done with direct project cost, capital allowance, taxable, reversal of allowance.
What, 1 second. So you flip so there's negative.
In the initial 3 years, we required the investment, and then we took out the amount from the working capital.
Oh, okay.
Now these 4.974 was invested initially. Then the difference was invested. Then the difference was negative amount, so we took out the amount. And then the net amount was also taken out. So the investment amounts are shown negative.
The
withdrawals are shown positive.
Got it.
Okay. So let's look at it. If anything is left, I don't think. Okay. So I think we are done with all of the adjustments, sales, direct project cost, interest we have discussed that we don't consider it. Tax is done, investment and sale is done. Now what we have to do is the most important thing, which is discount factor. Because in APV calculation, we have to calculate the discount factor, which is related to the risk of the project. Okay. For that, I think we need to read something from here. Burung Company has identified a company, Link2 Company, which operates in the same line of business as that of project it is considering. Link2 Company is financed by 40 million shares trading at $3.2 each and 34 million debt trading at $94 per $100. Link2 Company's equity beta is estimated at 1.5. I don't need his equity beta. What I need is the beta asset, because the beta asset of Link2 Company will be the beta asset of my project. Okay, so let's start calculating it. We can easily calculate the beta asset if we have the beta equity number and the value of equity in that. So
so sometimes they give us beta equity. Sometimes we have to calculate. In the last question, we had to calculate.
In the last question, he gave us cost of equity, and from cost of equity, we calculated the beta equity through CAPM formula.
So what is So let me make a note. What is that? KE equals RF plus RM.
This is the formula of the CAPM. CAPM model, capital asset pricing model, which you study in WAC. Capital asset pricing model, risk-free rate plus RM minus RF into beta equity. In order to calculate cost of equity, you study two models, the dividend valuation model and the CAPM model.
So what is RF, RM?
RM is the risk. RF is the risk-free rate. RF is the risk-free rate plus RM, market rate minus risk-free rate. So you will get the risk premium which the market is charging, and then you multiply it with the beta factor, which is risk responsiveness.
Got it.
We will study it in detail when we'll discuss WAC. Okay, now working 6. Discount factor in base case NPV calculation of APV. In base case calculation of APV will be discount factor based on project specific risk. Based on project specific risk. Okay. Discount factor in base case NPV calculation of APV will be discount factor based on project specific risk. Okay. Now, project specific risk project specific risk will be similar to that of Lin2 company.
Yeah.
Will be similar to that of Lin2 company as it operates in industry, as it operates
Same industry.
in industry to which project relates. Okay?
Yeah.
To which project relates. Beta asset of Lin2 company, beta asset of Lin2 company will be same as beta asset of project.
Yeah. So we've got to use the formula beta asset equals beta equity, all that big old formula. Yeah?
Yes, will be same as beta asset of project as they both are in same industry and carry similar business risk, as they both are in similar industry and carry similar business risk.
Yeah.
Okay.
Yeah.
Are you getting it?
Yes, of course. Yeah.
No. So beta asset is equal to beta equity into equity divided by equity plus debt into 1 minus T plus beta debt into
Debt
D into 1 minus T divided by
E plus
E plus D 1 minus T. Okay.
Yeah.
So we are provided with beta equity.
Yeah. Beta equity is 1.5.
Lin2 company beta equity is 1.5. The value of equity is 40 million shares trading at 3.2. Okay.
So you're going to do it in 40,000 or you're going to do 40 million, yeah?
40 million into 3.2 will be the value of equity.
40 times 3.2 is 128 million.
Beta equity was 1.5. 1.5. Value of equity is 40 million shares multiplied by
3.2.
3.2. So it is
That's the equity, yeah? So that is 128 million.
128 million. And what about the value of debt? 34 million debt trading at $94 per $100. So 34 million divided by 100 into 94.
34
million is the value of, is the par based on par value.
Yeah.
Divided by 100 into 94. 94?
Okay. Yeah.
Yes. And the tax rate is 20%. What is the value of debt? 34
divided by 100 times
31.96. Okay. So beta asset is equal to beta equity 1.5 into equity 128 divided by 128 million
plus 31.96.
31.96 into 1 minus
1
20%.
minus 20%, yeah.
20%. So it will get after tax. And the beta debt value is assumed as 0.
Why is it assumed at 0 again?
Yeah. Because debt is normally assumed as risk-free. So in case of debt, we assume that there will be no additional risk responsiveness.
So I'm going to say debt assumed risk-free, yeah?
Unless the examiner states otherwise.
Okay. Yeah.
Beta debt is equal to 0 as examiner is silent.
1 minus, okay, so 0.8 times 31.96 plus
Therefore,
128.
Normal assumption is that debt is risk-free. Therefore,
Perfect.
beta debt is 0. Okay?
Yeah.
So 0 multiplied by any number will be 0. So the beta asset will be
1.25.
1.25. Okay? Now, this beta asset of Link2 company will be used as beta asset for project. Okay?
This beta asset of Lintu will be used as beta asset for project. Yeah.
Why? Because they both have same risk, because they operate in same industry. As beta asset for project, because Link2 company and project are in same industry, are of same industry, therefore share business risk.
Yeah.
Share business risk. Okay?
Yep.
Now, as the project will be 100% equity financed by the Burung company, therefore the beta asset will be equal to beta equity.
How do you know the project is financed completely by Burung?
Because it is the basic assumption of the APV that the company will finance the project. When we calculate the APV, I taught you in the previous class also that the company will invest in the project and then the company will raise the funds from the market.
Okay. So you said obviously as project will be 100% equity finance, so this will be considered as the beta asset is equal to the beta equity.
As Burung company will finance this project, through 100% equity. Therefore, beta asset will be equal to beta equity. Okay.
So what is the formula KE? That is the CAPM one, but what is KE?
Cost of equity.
Or cost of equity, okay.
KE is equal to RF plus RM minus RF into
so cost of equity is basically discount factor.
Yeah, the cost of equity is the discount factor in this case because we are assuming 100% equity finance. Otherwise, the discount factor is the weighted average cost of capital, which also includes the impact of KD, cost of debt, and it will also include impact of KP, cost of preference shares, that you will all discuss when you will be studying the chapter of WACC. Okay?
Yeah.
So, cost of equity here will be RF is the risk-free rate is 2%. The current yield on government treasury bills is 2%, and the market risk premium is 8%.
So that 2% is RF, yeah?
RF, and he has directly provided us the premium. Premium means RM minus RF.
Market risk premium, okay, and that is
8% is the premium.
That is basically RM minus RF.
So 8 into
That's the premium.
1.25 plus 2. So the rate is 12%.
Okay, right, okay.
So now this is our discount factor for base case NPV. Okay.
Lovely.
If you want, I can write one statement more here. As in base case NPV, project is, as in base case NPV, project is assumed as, is assumed as 100% equity financed by company, equity financed by company. Therefore, KE will be considered as WACC of project. Okay?
Yeah, got it. That's good.
Will be considered as WACC of project. Now, basically the model is that Burung company will be 100% equity owner, will be 100% equity holder of project, whereas Burung company
They'll
will
have
raise
60%,
finance,
60% from
subsidized
60%
loan,
loan from government,
subsidized loan,
and 40% from market.
40% normal loan. Okay, but
Okay.
the base case NPV the base case NPV is this. This is the base case NPV. Okay, this part is base case NPV. In base case NPV, we consider this part. Okay, and this above part this above part is the financing adjustment. These are the financing adjustments which we do after the base case NPV. Okay?
Yeah.
Are you getting it?
Yes, completely, sir.
So now the discount factor is 12%.
Yep. So you can use the table.
Okay, first of all, we had to calculate the net cash flows.
What's the next question like? Is the next question different?
One adjustment will be different in the end that you need to study.
And so once that we do that question, we've covered APV.
We have covered all the adjustments of APV.
Lovely, sir.
And then we'll move towards
Very nice.
Then the remaining appraisal techniques are very easy. IRR,
Lovely, sir. Lovely. That's what I want to hear. I'll start from end, yeah?
Yeah, 6.5, 16.94 minus 3.3 plus 2 minus 3.8. It's 11.84.
Last one, 25.78.
25.78, 27.19 minus 5.4 plus 4.5 plus 4.9. It's 28.19.
19, yep.
So now let's put up the discount factors.
So we have to do 12%. Is this the normal present value table? 0.893?
Discount factor 12%, yes. 0.893.
I'll tell you, sir. Don't worry.
Yeah. 0.893.
0.797.
0.797.
0.712.
Yes.
And 0.636.
So these are the present values. $42.9. And this will be our base case NPV. So 6.5 into 0.893. Yes. Last is
16.39.
16.39, 9.43,
and 20.07.
28.07. Sorry?
Why have you
20.
put the last 20.07?
Yes.
Why have you put negative? Oh, was that supposed
Because
to be
these
negative?
are the investment amounts, na? Here 0.
Yeah,
These
okay,
are
okay,
the
okay,
negative
yeah.
ones. 42.9 minus 5.8 minus 9.43 minus 20 minus 16.39. So the base case NPV is 8.72 negative. Just a minute, I think I have done something wrong. 42.9
It's positive,
minus
positive,
5.
positive,
Yeah, it's
positive.
9.43.
8.79.
8.79.
Yeah.
So let's do the financing adjustments. So the first financing adjustment will be of issue cost. Now, if you look at the issue cost, he says that, yes, here it is. Issue cost related to raising the finance are 2% of the gross finance required. The remaining 40% will be funded from Burung Company normal borrowing. So it is 2% of the gross finance. Very simple. We require 42.9. 42.9 million divided by
98%.
98% into 2%. So this will be 42.9 divided by 98 into 2. 0.87.
0.87.
0.87. Okay.
Tax benefit is
Tax
benefit is 0.87 times 20%.
on issue cost. $0.87 million into 20%. How much?
0.174.
Sorry?
0.174.
174 million. Okay. Then we have to take impact of tax saving on interest cost.
This was a bit tricky, wasn't it?
Okay. Let's look at it. Tax saving on interest cost. Now, when we talk about it, how much is the borrowing ratios if we look at it?
Borrowing was 80% and 20%. 60-40, 60-40.
Yes. 60% of which will be obtained from subsidized loan scheme run by the government, which lends 100 basis points below the 10-year government debt yield of 2.5%. 100 basis points below. Okay. So the amount we require is 42.9 million.
Times 60%.
42.9 million into 60% into 2.5% minus 1% multiplied by tax rate, which is 20%, multiplied by 42.9 is the amount required, 60% is the subsidized loan, 2.5 minus 1 is the subsidized rate, and 20% is the tax rate.
And then now we have to do the annuity factor of 4 years.
Annuity factor of 4 years at market interest rate. Yes.
Which is 2.5%.
So I will write a brief comment here on it.
Is it 2.5%? Yeah. Yeah.
No. 2.5% is the debt yield rate. The market rate was, I think, 150 basis point above.
Yeah. Sorry. which lends money at a rate of 100. Oh no. 150
As,
above. 150 above.
as tax saving will be for 4 years.
So it's 4%.
Will be 4 years. Therefore, in order to calculate present value of tax savings, annuity factor of 4 years will be used.
Yeah.
Of 4 years will be used. Okay? As
Yep.
transaction
So
is
it's
debt
4%.
related.
4%.
Yes, as transaction is debt related. Therefore, market interest rate will be used for discounting.
Okay. So it's 4%.
Will be used for discounting. Okay. Market interest rate is 2.5% is the risk-free rate. And we borrow 150 basis point above that.
So 4%.
Yeah. Now check the annuity factor of 4% on 4 years.
4 years is 4%. 4 years is 3.630.
Of 4 years is
3.630.
630. Okay. You check from the table. 3.630.
Has
42.9.
Sir Mustafa landed?
He will land tonight 1:15.
I messaged him yesterday saying have a safe flight. He got very happy that I messaged. He got happy that I remembered. I said to him that you told me.
42.9, 60%, 2.5 minus 1, 1.5% into 0.2 into 3.630. So it is 0.280. 0.280. Okay? Then again 42.9 million. 40% of the loan will be normal loan. 2.5% plus 1.5%.
This is normal market interest, isn't it?
Yes. Into 3.630 again. So 42.9 into 0.4 into 0.04 into 0.2 into 3.630. So it's 0.498. Okay?
Yeah.
The last adjustment, tax benefit on subsidized loan. Okay?
Yeah.
Now, the subsidized loan is 42.9 million into 60%. Multiplied by. Normal interest rate is 4%.
Yeah.
And subsidized rate is 1.5%.
Wait. What are you doing here? Oh, you're doing 1.5 below. Okay.
Why can I do working 8? I can do working 8 here.
One second. What have you done there, sir? Go back.
Just a minute. Normal loan rate is 2.5 plus 1.5.
Yeah.
This is your normal loan rate. What is your subsidized rate?
1 basis point below. So they do at 3.
2.5 minus 1. It's 1 basis point below the debt yield government rate, not below our rate. If you look at it here, the subsidized loan is 60%, 100 point below the 10-year government rate.
What did you do above then? You did before you do
Just a
4.
minute. 1.5, 4 minus 1.5. So what is the subsidy benefit? What is the subsidy benefit?
2.5.
2.5% is the subsidy benefit. So I have written 4 minus 1.5, the subsidy benefit. What will be my subsidy benefit? Every year I will get benefit of 2.5%.
Okay.
Okay?
Yeah, yeah.
Now what you can do is you can simply write 2.5%. Working age.
Oh, you okay, yeah, you've done the work.
Because I've written the complete here.
Yeah.
Okay.
Okay.
So now this is my subsidy benefit. Then multiplied by 1 minus 20%. So that this subsidy benefit gets after tax. And then multiplied by the annuity factor because it will be every year saving.
Yeah.
Okay.
Yeah.
42.9 into 0.6 into 0.025 into 0.8 into 3.630. So it will be $1.86 million. Okay. Do you want me to repeat?
No, I've got it. It's fine.
Okay. So my adjusted present value will be 8.79 minus 0.87 plus 0.174 plus 0.280 plus 0.498 plus 1.868. So it's 10.74 million.
Lovely, got it.
74 million. Adjusted present value. Okay. So if you look at this question, it had no new adjustment. It was almost, I would say, same as a Fubiki company question.
Yeah.
Okay. Now the next question, which is of APV, that is Embreely company. That is almost same, but only one new adjustment in Embreely company. Now that new adjustment is, if you read it here, Embreely company's chairman had noted that all of the company's debt, including the new debt, will be repayable within 3 to 5. No. Yes, here it is. Bank loan repayable in equal annual installment over the project's life. Now, the problem in this question is that in this question, the loan will be repaid in annual installments, which means that at the end of every year, the loan balance will get changed.
Okay.
And due to that, the amount of interest will get changed. But now, if you look at the normal questions, what we do is we simply take the loan amount and we multiply it with one interest rate. In these questions, we assume that the loan will directly be paid at the end of the project, which means that the loan balance will remain same throughout the project life. But in Embreely company, what will happen is that the loan balance will decline every year because you will make annual installments.
Got it. Okay.
Now, when the loan balance will change every year, you have to calculate a different interest amount of every year. So you have to make a loan amortization schedule in this question.
Okay.
And that will be the only new thing. But the impact of that will only come in this adjustment. The whole question can be done. Only this part will create problem.
Got it.
Okay.
Got it.
But I'll do it in the next class, not today, because it's getting late. Tomorrow we'll do a longer class because I think you said that tomorrow.
I'm leaving tomorrow afternoon.
At what time?
I'm leaving at 3 o'clock.
3 o'clock. So 3 o'clock means 11:30 at my side.
No. My 3 p.m. will be your
My
7
7,
p.m.
okay. We can take it. We can take it 4 p.m. my side. My
Okay,
side,
so
so it will be 12 your side.
Yeah, that's good. That's good.
So we can complete the umbrella company question also, and then we'll complete the small techniques, IRR, ROS, payback period also. So then,
If you can do earlier, can you do earlier at all? 12's okay. 12's okay. 12's okay. Actually, it's fine.
12
12's,
years, yeah.
12's my first good.
Okay.
Yeah.
So, and on Saturday, Sunday, you are not available.
Saturday, Sunday we'll have break because I'm not here, and then we'll start again Monday.
Right. So then we'll go for the past paper session because our investment appraisal area will be done. So we'll do 2-3 questions and then we'll move towards WAC.
Thank you, sir.
Thank you.
Bye bye.